Russia's problems are no longer limited to the front, but also affect the economy. A government deficit that in the first 4 months of the year is already 50% larger than what was planned for the entire year. The deficit is so large that the central bank and the finance ministry are demanding a reduction in military spending. This is happening while companies are going bankrupt and there is a massive sell-off of state gold reserves. And Russian citizens are increasingly losing trust in banks and are keeping their money at home under the mattress. All this is happening while the oil industry is being severely weakened by ongoing Ukrainian attacks. And now 30% of gasoline and 25% of diesel production are affected. So how much longer can Russia economically sustain the war? That's what we want to talk about in this video. Holy smokes! Now save the most at Holy with my code. Interfax reported on the 8th, citing the Russian Ministry of Finance. May 2026, the deficit of the Russian federal budget in the first 4 months of the year was 5.877 trillion rubles. Russian data shows this equals 2.5% of the gross domestic product. This is already remarkable because the total deficit for the year 2026 was planned at 3.786 trillion rubles, which is 1.6% of the GDP. In other words, after just 4 months, the deficit is already 50% higher than what was originally planned for the entire year. Of course, the Russian Ministry of Finance explains this high figure partly with front-loaded spending, and it corresponds to pre-financing, earlier contract signing, and early payments. And that is quite plausible to some extent. Of course, states do not spend exactly 1/12 of their annual budget every month. With larger government contracts, expenses may be higher early in the year. However, this doesn't fully resolve the issue, as the numbers structure is still problematic. The revenues of the federal budget declined from January to April 2026. Compared to the previous year, 4.5%, so Russia collected almost 5% less. At the same time, expenditures increased by 15.7%. That means Russia is spending significantly more but taking in less. And that's especially important because oil and gas revenues fell by 38.3% during the same period. And that's the real core of the problem. It's not just about Russia having a deficit. It's also about the fact that expenditures remain high because of war, armaments, security, social benefits, and subsidies. While, of all things, the most important traditional source of revenue is becoming significantly weaker. The situation is so serious that the Ministry of Finance and the central bank are urging the Kremlin to cut military spending as the deficit grows dangerously large. Thanks to its vast wealth of oil and gas and the infrastructure for it, most of which was built in the Soviet Union, Russia always had something to support its budget on a large scale whenever commodity prices rose. When Putin moved into the presidential palace in Russia, the price of oil was around $20. Since then, it has averaged over $50 with peaks above $100. That filled Russia's state coffers and made reforms seem unnecessary. Because high energy prices also mean high government revenues. These revenues have financed the budget, the security agencies, subsidies, pensions, and now the war. Sanctions since 2022 have reduced that, but not enough to stop Russia in the war. On the one hand, Europe, like an addict, couldn't completely let go of the needle and continued to buy hydrocarbons from Russia. In fact, even more money was transferred to Russia than was provided in financial and military aid at the same time. That was not only enough to stabilize Russian revenues, it also reduced the deficit. The Iran war increased revenues even further. But by now, Ukraine's kinetic sanctions have become a major factor. Because of ongoing attacks on Russian oil and gas infrastructure, from pumping stations to tanks, refineries, and loading ports, Russian oil and gas revenues in the first 4 months of the year have fallen significantly below those of the previous year. This is especially problematic for Russia since expenses are rising simultaneously. While Russia needs more and more money to run its war economy, not only are its reserves decreasing, but above all, its revenues are also falling. The table on oil and gas revenues published by the Russian Ministry of Finance shows the same pattern over several years as well. In 2022, oil and gas revenues were very high. And in 2024, they were also at a high level. In 2025, they were already significantly weaker. And at the beginning of 2026, the pressure is clearly visible. As it looks, oil and gas will no longer be able to support Russia's war economy, while Ukrainian attacks are even intensifying. Sanctions, price discounts, higher transportation costs, the shadow fleet, technical problems, attacks on infrastructure, and necessary subsidies at home are all changing the equation for Russia for the worse. €1,172 wouldn't help Russia much. but it might pay for a vacation for them, because that's how much money 90% of users get back from the tax office on average when they use Zaster. Most people find tax returns too complicated, and I can totally understand that. That makes today's partner Zaster even better, because it's extremely easy to use and lets you check for free if you're eligible for a tax refund. Just register, enter your name, address, and tax ID. Then you give authorization so the tax advisors can check it for you. After that, you'll receive a free offer. The whole thing only costs you something if you get a refund with Zaster, and the fee is deducted from that. 9 out of 10 users get money back, and that's for up to 4 years retroactively, with an average of 1,172 euros. And with the code MILGESCHICHTE, you get a €20 discount on the tax advisor fee. The whole thing usually only takes 3 minutes, so there's really no reason not to do it right after the video ends. On average, that's 1,172 euros for 9 out of 10 users. Money you would otherwise throw away. So scan the QR code to go directly to the App Store. Use Zaster, get a free offer from the tax advisor, and with the code MILGESCHICHTE, receive a €20 discount after a successful refund. But declining oil revenues are not everything. Ukrainian attacks have now caused major outages at Russian refineries. So much production capacity has been lost that Russia has once again considered stopping exports of refined products, and has now implemented this. Not only are the profit margins for diesel, gasoline, and kerosene naturally much higher than for selling crude oil, an export ban highlights the domestic shortage. Less availability, however, leads to higher prices, not only for the military, which also has to pay for its fuel, but especially for the rest of the country, meaning citizens and businesses. If the oil industry is less efficient, not only does industrial output fall, but revenues, taxes, and export earnings also drop, or at least the state's profit margin does. At the same time, transportation costs rise, which is one of the main cost factors in the economy, because every raw material, every component, and every finished product has to be moved, just like every worker on their way to work. Of course, this has a name: inflation. If fuel prices in Russia rise by 50%, that means additional costs amounting to 2% of GDP, and even if imports from Belarus increase, the country cannot even begin to make up for the shortage from Russia. Attacks on refineries mean that even if global oil prices rise, Russia doesn't benefit from them for long. A high oil price only helps completely if you can also produce, transport, refine, and export it. But if refineries are damaged, ports are attacked, pipelines fail, oil wells are shut down, or the shadow fleet becomes more expensive, then part of these problems immediately eats up the advantage of higher prices. So Russia no longer has enough revenue and has a budget deficit. But where is the problem? Western countries also have deficits. The difference lies in the structure. Russia is not just a normal country with a normal economic problem. Russia is a war economy. That means the state is directing more and more resources into the military sector. The arms factories are operating at full capacity. Workers are being sent to the front or into the arms industry. The competition has caused wage costs to skyrocket, without simultaneously increasing productivity. Higher wage costs for arms workers and soldiers fall directly on the state budget. Regions pay high enlistment bonuses, which financially overburdens them and leads to a reduction in services or significant new debt. The civilian sector is crowded out by high interest rates, significantly increased taxes, and massive wage increases, which reduces real tax revenues. And the state has to finance all of this without creating anything that would later generate economic growth. Other countries take on debt to build roads, railways, canals, or power plants, all things that subsequently enable economic growth. Russia spends money on metal that ends up burning in Ukraine or on citizens who fill graves there. So the financial needs increase with each passing day. The factories are running and unemployment is low. Wages are rising in many sectors. Consumption can even be supported in the short term through government payments. But this is not a sign of healthy productivity. It's not growth for the future, but rather economically sawing off the branch Russia is sitting on. And that is exactly the central danger. The Russian economy is growing, to the extent that it is growing, increasingly due to government wartime demand. This is not normal broad civilian growth. It is growth through mobilization, which brings the country no lasting prosperity and is financed by the state, not through private sector creation of wealth. But the economic consequences are not limited to the official state budget. Not all war costs are properly accounted for in the federal budget. Part of the burden is shifted to other areas. to regions, to state-owned companies, to banks, to arms manufacturers, supply chains, payment arrears, to cases needing restructuring. Not to mention long-term costs like support for veterans and the disabled, and pensions. When the Russian state orders weapons and only pays part up front, someone must finance the remainder. High interest rates make this interim financing costly. Since the allowed profit margins for defense contracts are low, companies can get into financial trouble even with full order books. And that's the paradoxical point of a war economy. A company can have a lot of work and still be under financial pressure. Full order books do not automatically mean healthy balance sheets. Nevertheless, it's up to the Russian banks to provide interim financing. On the one hand, they are needed for interim financing of struggling state-owned companies, but also for financing the national debt itself. For a while, it can work if the government issues debt and the banks buy them. Then, because of the bonds they have on the asset side, they can borrow money from the central bank again. It appears clean on balance sheets, but it's not truly free economically. The burden appears elsewhere. On bank balance sheets, in reduced profits and higher interest rates. Less credit for the civilian sector, possibly with the government again, and with inflation. A war economy can seem stable for a long time because Russia shifts and reallocates its problems. Russia shifts them to state-owned companies, banks, and regions. But of course, that doesn't make them disappear. It's no coincidence that Russians have withdrawn so much money in recent weeks that euros and dollars have become scarce. Some Russians understand that the banks are increasingly on shaky ground as well. But when they say, Putin regularly points to the low unemployment rate. Formally, that's understandable, because low unemployment always sounds good. In times of peace, it is actually a sign of a booming economy. But in Russia, it is more of a bad sign, because low unemployment not only shows that people have jobs, it also shows that there is a shortage of workers. Many men are at the front, possibly over 1 million of them already dead or wounded, and thus permanently lost to the military and the economy. Another part is working in the massively expanded armaments industry. High military bonuses have attracted many civilians to the Russian armed forces, which are now twice as large as 4 years ago, despite all the losses. But some of the skilled workers have also left the country to escape mobilization and repression. The result of this is that companies are finding it harder to recruit staff. So wages are rising across much of the country and across industries. Inflationary pressure remains high. And that's why the central bank can't simply lower interest rates. High interest rates, in turn, put a strain on companies, investments, and credit financing. And that's the cycle currently in Russia. The war creates demand, but it also takes away workers. The labor shortage, in turn, drives up wages. Higher wages and government spending push up prices. A tax on refineries do as well. That's why the central bank keeps interest rates high, which puts pressure on companies. And yet, the Russian state still has to keep financing all this with lower oil revenues. So Russia does have major problems. That's undeniable. However, Russia is not on the verge of collapse. The Russian state still has significant resources. It can keep raising taxes, providing short-term relief for the state budget, even if it forces companies into bankruptcy. In fact, company bankruptcies are rising sharply. 209,000 companies filed for bankruptcy in the first quarter of 2026, more than in the previous year. But one could cynically say that also increases the number of unemployed people who can then be used as soldiers or workers in other areas. Russia can continue to borrow domestically. Currently, banks are still buying government bonds because they offer higher returns than the real economy. Russia can also continue to use its reserves. Its wealth fund still has 3.6 trillion rubles, about 43 billion euros. It can also sell more gold. This year, $4 billion have already been generated by selling 900,000 ounces. According to the Russian central bank, Russia still has around 73.8 million ounces of gold. That amounts to a proud $330 billion. But of course, that's only theoretical. If Russia were to sell gold in such large quantities, the price would start to drop sharply, and Russia would earn significantly less. So, Russia won't be able to stabilize its budget with gold alone. However, Russia can also prioritize its spending. It can neglect civilian sectors and prioritize military ones, which makes the people more dissatisfied. Recently, support for Putin had dropped significantly, but it was still at a very high level, so he won't have the majority of the people against him anytime soon. Putin can also force companies and oligarchs to participate in the war effort. For some time now, companies have also had to participate in recruitment. And in April, it was reported that the oligarchs had certainly made completely voluntary donations to the state, amounting to billions. That can continue, even if Putin makes enemies because of it. Authoritarian states can also conceal economic burdens for longer than open societies, because they have to take less account of voters, consumers, businesses, or the media. So if the Kremlin decides that war spending takes priority, then war spending takes priority. As long as the people don't take to the streets with pitchforks, Putin can cut spending on everything else to continue financing the war in the short term. That's why it would be wrong to say that Russia will be bankrupt tomorrow. A better way to put it is, Russia still has some leeway, but that leeway is getting smaller and more expensive. Strategically, this development is uncomfortable for Russia, because the war forces the state to prioritize. The longer the war lasts, the more money the state has to put into the war and everything related to it. But every ruble can only be spent once. If more money goes into the war, there will be less money available elsewhere. A country can cope with 1 or 2 years of neglecting infrastructure, education, health, research, and modernization. But the longer it lasts, the greater the damage will be. If a steel bridge isn't painted for 2 years, rust may start. Leaving rust for 5 years causes worse damage. If it's not painted for a long time, it might start to rust. Our car at home can also go another 10,000 kilometers without an oil change at first. But later, engine damage will cost much more than just changing the oil and filter a few times. The Russian economy is similar. For an economy already struggling with sanctions, limited capital, and worker shortages, that's dangerous long-term. Not because Russia will go bankrupt soon, but because its economic foundation is gradually eroding. That's why you shouldn't underestimate or overestimate the Russian economy. It's not healthy in the usual sense, but it's also not on the verge of collapse. It is a mobilized war economy. Such systems can function for a long time, but they work by pulling resources from the future into the present. What would have made the country better in 10 years is being consumed today. The 20-year-old, who in 10 years would have become a master craftsman, started a company, or made a scientific discovery as a professor that would have advanced Russia, is now lying dead in the fields of Ukraine. This principle is clearly reflected in the current figures: a very high deficit after just 4 months, rising expenditures with falling revenues, sharply decreased oil and gas income, a tax on refineries and energy infrastructure, burdens on state-owned companies and banks, and an economy that is increasingly shaped by the war. So it's wrong to say that Russia will collapse tomorrow. Rather, it's correct that Russia continues to wage the war, but the war is becoming increasingly expensive for Russia fiscally, industrially, and structurally. And that's exactly where the strategic significance lies. An immediate collapse is unlikely. Instead, the Russian war economy is increasingly running on wear and tear. It still works, but it increasingly works at the expense of its own future. Russia may still be able to keep fighting, but in doing so, it is gambling away its future.